Yes, questions. All right, ladies and gentlemen, thank you very much. Thank you for the glass clink like an early 90s wedding. Appreciate it. Ladies and gentlemen in the room and joining us online, welcome to the Canadian Club of Toronto and our event on shareholder activism. My name is Bruce Sellery. I'm the president-elect of the Canadian Club and your host today. Now, there are a number of ingredients that make our events successful: the venue, the food, the high caliber of speakers that we attract, the engaged audience members who ask insightful questions, and also our sponsors. So I want to take a second to acknowledge the generous support of today's sponsors: National Capital Markets, represented by Andrea Mandel-Campbell and Rick Murray, and PwC, represented by Anita McQuitt and Michael Patterson. Round of applause for our sponsors today. Thank you very much. I would also like to welcome the participation of the youth and young leaders attending today from the Rotman School of Business. Where's our youth and young leaders today? Give us a woot, like a hello. Thank you for coming. You're the future. Don't mess it up. And to introduce our panelists, Ben Axler. Ben is an activist, short seller, and forensic financial researcher who has exposed over $1 billion of alleged frauds on the NASDAQ and the NYSE. Prior to founding his company, he spent 8 years as an investment banker. Patricia Olasker. Patricia acts on behalf of many of Canada's most complex mergers and acquisitions. She was lead counsel for Burger King Worldwide in its multi-billion-dollar acquisition of Tim Hortons, and for McKesson Corporation on its acquisition of Rexall. Sunny Puri. Sunny is a principal and portfolio manager at Anson Funds, with offices in both Toronto and Dallas. Prior to joining Anson, Sunny worked at RBC Capital Markets within the Mergers and Acquisitions Group here in Canada and in the Corporate Finance Group in Australia. David Salmon. David is responsible for Laurel Hill's Strategic Shareholder Solutions and for corporate governance consulting services in Canada. He works with senior executives, board members, and shareholders on many of Canada's most notable corporate transactions. And moderating today's discussion is Andrea Mandel-Campbell. She is Senior Vice President, Financial and Crisis Communications at National Public Relations. She's the best-selling author of Why Mexicans Don't Drink Molson and is an executive member of the Canadian Club. Andrea and panelists, I am pleased to pass the Canadian Club podium over to you.
Thank you very much, Bruce, and thank you so much for joining us today. Once again, I want to encourage everyone, any questions you might have. I know there's a lot of folks in the audience who are going to have some interesting questions, so I encourage you to all bring them up. I don't want to monopolize the stage here. You've got some great people on the panel, and pick their brains. That's why you're here. So I wanted to start off the conversation. The sense is, anyway, that there's a lot of activism going on right now. We're seeing some pretty interesting stories, particularly here in Canada in a few sectors. I want to get a sense from our panelists, and I'll start with David and we'll move our way this way, is if we're seeing, from your sense anyway, if activism is on the rise, and your sense of why that is, and if there's any particular trends that you're noticing. David.
Yeah, absolutely. Thank you. Certainly, activism is on the rise. On average, we've seen about 12 proxy battles per year. Certainly, that was higher last year and in 2017, and by all accounts, it's anticipated that'll be higher this year. Last year, we had about 18 proxy battles. A lot of that is just, excuse me, valuation metrics drive a lot of this. And let's be honest, ego also plays into this consideration. But there's, particularly right now, you're seeing in the mining industry, in the oil and gas industry, valuations are generally down. What people's anticipated perspective of their worth is fundamentally different than others that are making an offer. So you are seeing a rise in transactional activism and proxy battles. For the most part, these are efforts of last resort. They are not something anybody jumps into. And I will give you an example as to why. The Procter P&G case in the US, the estimated costs on that were $75 million total. That is certainly a lot higher than you are seeing in the Canadian market, but on a proxy battle that we worked on recently with a market cap of $250 million, the company's costs were $5 million. And this is all gone from your free cash flow. So activists, on the flip side of that, can spend anywhere from $1 million to $5 million on a similar type of mandate. So they're very costly. If you win, you generally get your money back. If you don't win, that's a very expensive proposition. In terms of some of the trends that we're seeing, and I'll jump in here, obviously, Dissent rights are probably one of the more interesting things that we're seeing. Dissent rights are basically when you disagree with the valuations of a merger transaction, you have the ability to take it to court, and the court will review it. We've seen quite a few dissent rights coming through. It is a very tactical play. In a recent one that was quite interesting, we saw professional dissenters out of the US. And what they did was they dissented their shares. It was about 8 million. The company did not want to go to court to work out the valuation. This would have taken quite some time. They offered them an increase. It was about 10 cents per share in the increase. So in a matter of 3 weeks, they made $800,000. Our concern is that this is going to become a bit more of a trend, and dissent rights generally have thresholds too. So it can be a way to kill a transaction. I won't go into too many more, but maybe I'll just pass it on down the line here.
For sure. I would just add that surely activism's on the rise, as has been explained, and you can look at any of the statistics to see it. But it also helps that we're in the 10th year of a bull market post-2008, and with valuation disparities larger than they have been in the past, you have both activism from short sellers on valuations that are probably too high, and you have activism in the mining and oil and gas and other spaces where value is perhaps not being seen. And I would just add that social media also plays a role within activism these days, and with the growing voice of the average person out there, this obviously adds friction for companies when they're trying to run their businesses.
So let me just add to that. I mean, there's no question we've seen an incredible uptick in activism in the energy and mining space. And I think a lot of that was the result of this Paulson report that many of you are familiar with that was delivered at the Denver Gold Show in 2017, where Paulson, focused a big gun on the gold sector, Canada in particular, accusing these companies of value-destructive acquisitions, excessive compensation, cronyism on the board. And he got traction with that thesis, and we very quickly saw the Detour Gold situation, more recently Hudbay, Guyana Goldfield. So we are seeing an incredible ramp up of activism in that space. Secondly, what we are seeing is really a sea change in terms of short selling activism. There were 22 Canadian campaigns of an activist short selling nature last year, which is off the charts. It was 9 in the prior year. And the proof of that is we've got 2 activist short sellers here on the panel. So we'll talk a lot more about that. And then last point, just on dissent activism, it's interesting that you raised it. So dissent activism is a big business in the US, as many of you know, and it really didn't catch on in Canada for the longest time. The reason is in the US, there's a statutory entitlement to interest on your claim for fair value. It's the federal discount rate plus 5%, and it's assured. Whatever the outcome, you get paid to play the game. In Canada, interest is in the discretion of the court. The contest can go on for a decade. It's just too costly to run the risk. So that hasn't changed, but what has changed, to your point, is a crazy decision out of the Yukon court about a week ago, where they actually awarded the claimant a 40% premium over the merger price as a fair value number. That's never happened before. So we think that will possibly unleash a torrent of dissent activism.
Yeah, I mean, from my perspective, and again, Spruce Point focuses on short activism. I'll echo a couple of the points that you guys made and touch on a few. Certainly, being in the 10th year of a bull market, valuations we think are pretty extreme, and certainly there's pockets out there of excessive valuation that, as a short seller, we look for that disconnect between intrinsic value and what the market's pricing something at. So valuations is a big one. Sunny touched on social media, and I think this drives at the heart of activism. Actually, the cost of activism has gone down from our perspective. Spruce Point has been able to really grow its brand on the Twitters of the world, or social media sites that are idea-sharing platforms like SumZero, or blogs such as Seeking Alpha. Anyone with a voice or a contrarian view can tap into these free resources and become an activist with almost no cost. So with costs coming down, I mean, activism by its very nature is rising. I think the third point, particularly in the US, and I see it's rising in Canada a little bit, is regulation, the regulatory environment. In the US, we have Donald Trump, and our belief is that he's very anti-regulation. He's pulling back resources on the EPA and the SEC, and we have government shutdown. So the regulatory environment, I think, is creating an opportunity for third-party activists to come in and sort of be the quasi-regulator policeman of the markets that just, isn't there. And then I think the last point I want to stress is that we still have a structural, I think, flaw in the financial system that allows the activist short seller to have a viewpoint. I mean, I can cite numerous companies we've targeted where you've had 18 or 20 analysts saying buy, and none of them are saying sell or strong sell. And so as long as that structural imbalance where you really have no alternative viewpoint that exists, I think that's going to continue to push activist short sellers to have a greater voice in the marketplace, to be that counterbalance that just doesn't structurally exist.
Yeah, I want to follow up on that, because a couple of the targets you've had where you found some pretty major gaping situations, and yet, as you point out, the analysts have had almost fully buy recommendations on some of these stocks. Can you give us some examples of that?
Sure. So I think one of our bigger successes here in Canada has been Maxar, which is formerly McDonald Detweiler. When we were evaluating the business, the analysts had $70, $80 price targets. Our extreme view is that Maxar was potentially worthless. Why? Well, they have $3.5 billion of debt, and the company was clear that they weren't going to generate any free cash flow this year. They had an irrational dividend that they were paying, despite the clear evidence that their main geospatial satellite market was slowly turning, and eventually, company recently said that they couldn't sell or they're going to retain that business. So, yeah, I think we look for variant situations, variant views, variant opportunities where the market is just structurally wrong and the price targets are off base, and we try to come and fill that void with the contrarian viewpoint backed by research, right? Mm-hmm. that we share with the public in a transparent manner.
Yeah, and just, to follow up on that, I was reading about one that you have, Caravana, which I thought was fascinating. 70 days of operating cash flow, correct, and they elect to give management 100% pay raise.
It blew my mind. My jaw dropped when I saw that, because they're compounding the problems to shareholders by paying themselves, and it's not even if they're paying themselves for hitting their targets. They're missing their targets, right? They miss their internal targets. They miss the Wall Street targets, but yet management's being paid more. I mean, these are exactly the type of situations we need to be going to their shareholders and say, why are you supporting this? Right? Are their interests aligned with yours? I mean, that's the ultimate question. Mm-hmm. And if you can't get comfort with that, I don't know how you can own the stock.
Right, and I think for a lot of the Canadian market, your target of Dollarama was a bit surprising, because for us, they were such a huge darling on the market for so long.
Right. I mean, well, look, with Dollarama, I actually visited a few. I'm here in town.
Picking up some stuff?
Well, I did notice, and my criticism of Dollarama remains the same.
It's okay, you can say it, it's all right. We're among friends.
Is that they're still not, they're shifting away from being a pure dollar store. And I went aisle by aisle to look, and I saw $3 and $4. And I asked the security guard when I walked in, show me where the dollar items are. And he kind of snickered. He's like, well, there's a few. But our criticism there was a little bit on the governance, the fact that the insiders are selling while the company's using short-term borrowing funds to buy. That struck us as a little odd. And frankly, Dollarama, the valuation, right? We look at other dollar stores across the globe, and we certainly have dollar stores in the U.S., and we ask ourselves, is Dollarama a superior dollar business model, and should investors be paying that premium valuation for that? That's kind of what we were really hoping to get investors to kind of think critically about the margins, the valuation, and the growth trajectory.
Okay, Sunny, what's a red flag for you, and kind of what is the process you use in terms of when you think about shorting a company?
Yeah, I'd say, when you look at a company, you first start doing your research, and from our perspective at Anson, we really like doing deep dive research, very similar to Spruce Point and Ben over here. The idea is you really want to understand a business model. And the first thing is there's, once again, in the 10th year of a bull market, you have a lot of flawed business models that may never yield any value to investors. And I'm sure everybody remembers last Thanksgiving, everyone was talking about Bitcoin and Bitcoin stocks, and everybody understood that there was a new type of mining in Canada, and that wasn't mining gold or anything else, it was mining Bitcoin. And lo and behold, a year later, no one was talking about Bitcoin. The prices collapsed, and the fundamentals of the actual business models weren't there. And incremental to that, you really want to understand management teams and management teams' background, because the funny thing is people often have a history of doing the same thing over and over again. And I think Ben, to his credit, in many situations where he's exposed questionable companies, it usually starts with management teams and boards that suffer from poor governance. And incremental to that is just the basic things from a financial perspective that you would look for. There can be a lot of accounting malfeasance. There can usually be hidden information. In the case of Valiant Pharmaceutical, which everyone must remember from the last few years, was a Canadian darling in no other way. You had a McKinsey, former McKinsey CEO who was changing the way pharmaceutical companies were going to operate, but hidden in the background, you had this fake business called Philidor, which completely unraveled the entire business. So it's really important to pay attention to the details, and really the attention within the details will set you apart from really understanding, there are quality companies out there, and there's some that lack that same quality, and those are the things that we employ through our research process when we really want to understand, whether a company is ultimately going to be successful and grow its cash flows, or alternatively not so much like some of the Bitcoin stocks of last year.
So,
Andrea,
sorry, go
can I
ahead.
just jump in to make an observation? I think, where we're seeing a lot of the short selling activism now is in the cannabis market.
Yes.
And short selling obviously loves a bubble. And I think at the moment we're enjoying a bubble where people are trading, they're following the fad, they're following the trend, they're not rational actors. And so we're seeing these crazy valuations. I think the short sellers have targeted almost every one of the big name cannabis companies at one time or another in the long history of the industry, the last 12 months. I mean, you're in that space.
Yeah, for sure. I mean, the cannabis space, it's the ultimate pie in the sky dream. Is you have these companies that are capitalizing on the first in 100-year prohibition of the next alcohol, so to speak. And it's very exciting because I think anyone in the younger generation, which often is retail investors at this point, understand that cannabis will have a place in the world. You have Canada that's legalized it both from a medicinal and recreational perspective. You have over 30 states in the U.S. that have medicinally legalized, and there's more that are recreationally doing so at this point. And it seems like the train has left the station in terms of legalization in the U.S., which is, we're talking about a total addressable market of over 80 billion and even larger if you include the world. So it's very exciting. And when there's a lot of excitement, and as we saw with Bitcoin, 15 months ago, the return of retail investors, the industry in the space, and especially from a stock market, it has the ability to get very excited. And when there's a lot of excitement, like some of you will remember from, during the mining boom a decade ago, you had a lot of stock promoters, you had a lot of questionable characters that end up coming to an industry that's very excitable, and that's exactly what's happened in the cannabis space. And so what's happened is you have short sellers who are doing work on these names, or you have long and short funds that are doing work on these names, and they start to understand that there's few quality companies, and there's a lot of them that are probably not going to grow into the valuation that there's currently afforded to them by the market. And that sort of goes to the actual intrinsic value of the company and what the business model is and what the management team is going to be able to create versus what reality actually is.
So following up on that, I mean, we're starting to see, Afria and a few others have been hit. With your analogy of mining, are we potentially seeing another Briex situation here with a cannabis company?
So Briex was my first experience with the stock, and I remember distinctly my uncle had his whole life savings into it. So it's an interesting story, and I'm sure a lot of people in the room remember it. I think when you speak about cannabis, at the end of the day, the idea is everyone's focusing on who's going to be the next Corona and who's going to be the next Coke. And the bottom line is there's only a few Cokes and there's only a few Coronas. And there's probably 300 cannabis stocks right now. So more likely than not, there's going to be a lot of companies in this space that probably don't do so well. And referring to what Patricia had mentioned earlier, it's one of the potential bubbles that exists in the Canadian market. And the valuations are quite high at this point. So there's potential for activism from a short selling perspective, and then there's also potential for a lot of these stocks to pull back, especially if the bubble-like tendencies that some of us are witnessing prove true.
And I'm assuming you're betting on that.
To an extent, but we don't talk about our positions.
Okay.
If I could just jump
David,
in
yeah.
there, Andrea, I
Yeah.
think what's interesting too is some of these valuations and the market caps are exceeding $10 billion. And when you're looking at the composition of these companies, there is a disproportionate number of retail shareholders, and that's what you were talking about earlier. So these valuations are not necessarily sophisticated, and we're only now starting to see some of the institutional investors and short sellers exposing some of these poor governance aspects, poor valuations, and it is causing a pullback. But the retail guys bounce it right back up, so crazily enough. But I think as we're starting to see the comfort level, more institutional investors coming into this space, we're going to see less opportunity for activism in there in terms of the governance, in terms of valuations, and we'll start to see, hopefully in the next 2 years, something that's going to cause a decline in activism in that space. But right now, it's ripe for it.
I guess I would actually argue that we might see more activism. I think we'll start to see the short activism recede. But once valuations come down to normal and these companies start to trade off EBITDA like a normal business, and you start to see the governance problems, the accounting problems, the disclosure problems, that actually might be an opportunity for the traditional, value-oriented activists to come into the space and, look to professionalize the board, management, make operational changes, the kind of traditional activities of a value activist.
Yeah. Now, a lot of the companies that have been targeted have been coming through the U.S., which is one of the reasons we wanted to have you here and joining us. I'm just curious. I mean, whether it's your perception that Canada is a particularly fertile ground for activism. Mark Cahotis has been quoted as saying, as a well-known U.S. activist, that Canada is actually a haven. He called it for corporate malfeasance, because according to him, our white-collar laws are more lax than the U.S., and there's just more opportunity. The regulators aren't as on the ball necessarily. I wanted to get your perspective on that.
Yeah, I view it more from just like Canada being a smaller microcosm of the U.S., right? It's just a structurally smaller market, right? So like when we look at Canadian companies, we might only see a handful of analysts covering that stock, whereas I referenced some companies in the US we've looked at have 20, 30 analysts, so it's hard to really have an edge. But here in Canada, where you have a more, I guess, insular, smaller market of fewer analysts, and to what we know, very few forensic sort of independent, short selling firms, we view that as an opportunity, and that's why we've come to Canada. It's not because I don't love Canadians. I love Canadians. I have many good friends that are Canadian. It's nothing personal. It's just, it's in a market opportunity. It's a less efficient market, and we in the quest for alpha have come, looking for inefficiencies in Canada, and I think we've found them, and I think we'll continue to find them.
David, any thoughts? I'm curious to get your perspective in terms of at least the difference that you see between how things operate in Canada and when a U.S. activist comes into the market.
Certainly, there's some fundamental differences. I'm going to tread carefully here with...
Don't be too polite.
Well, Andrea and I were speaking, and I think that you cited a wonderful example of this. Is on the same day last Wednesday, they had Michael Cohen and we had Judy Wilson-Raybould. And if you watch the two of those being the discussion, it was very aggressive in the U.S., I think is a fair statement. Here we were having people who the decorum was a lot different. They were a lot more polite. They were asking if they could interject. I think that is one aspect of it. There's a much more aggressive nature that comes with the U.S. And in many of the cases of activism that go from from the U.S. into Canada, it's led by hedge funds, ARB funds, and short sellers. And I think that it's fair to say there may be a little bit more aggression with that group than what you're seeing with issuers, because their hands are tied through regulatory and legislative aspects. So certainly that's one aspect where it is a little softer, kinder, and gentler Canada. And many times, depending on the shareholder composition, you need to be cognizant of that. You need to make sure that you are targeting the demographic, if you think of it like in keeping with the political theme here, targeting that demographic that you want to engage with. And in many cases, the aggressive tones don't always resonate with Canadian retail shareholders.
Okay. So you've seen then, you would say, some examples where perhaps a U.S. activist has come in and maybe not understood culturally how he needs to approach either the company or shareholders writ large.
Yeah, absolutely. And I would cite a couple of, one example right off the top of my head is Taseko. It's a mining company out of Vancouver. There was a hedge fund out of Chicago, took a very aggressive tone, a very aggressive approach. It didn't work out well for them. Generally speaking, when you get down to a vote in an activist battle, it's splitting hairs. It's very, very close. That one, the vote was highly disproportionate. It was over 80% in favor of management, and a lot of it came back to the tone and the tenure of the arguments that were being put forward by the activist.
They end up having to issue an apology. Is that correct?
Pardon me?
They ended up having to issue an apology in the case?
They did have to, they made a claim that was knowingly wrong. It went through the court systems, and litigation is part of a strategy of activism. For the most part, once the activism is over, most people let litigation go. They don't want to incur any more costs. These individuals took it quite personally. The management of that group pursued litigation, and they won, and they did not ask for any financial compensation. They asked for a public apology from the hedge fund. So during PDAC,
have you ever had to issue an apology?
during PDAC at this point in time,
If you're right, you'll never have to apologize.
I know Sonny's been sued a little, but we'll get to that. But I mean, on that note, talking about the idea of there's a few questions here, and I think they're all around, you know, the downside of activism, and to the degree that interests truly align between the activists and actual shareholders or the company. Maybe if you could speak a little bit to that.
No, so the downside of
You
what we're doing?
Yeah.
It's a tough question, right? I mean, look, I think for us, we try to be as transparent as possible. We never tell anyone to sell, right? If you go to sprucepointcap.com and read our research, number one is we're very careful what we say. You know, you talked about litigation. I mean, we try to avoid litigation at all possible. We don't see that as a productive means, you know, for us or for another party. The lawyers win, but we don't tend to win, or, you know, the other parties don't tend to win out of that. I think so for us, you know, we have to be very careful about, you know, our research, what we say, how we say it. We try to be very meticulous in terms of sourcing things, because you're right, you know, part of the downside of our model is if we're wrong, then we do expose ourselves to the headaches of a potential litigation or regulatory, you know, inquiries. You know, we were also talking about, you know, this short activism has invited certain parties in that, you know, maybe aren't as careful, and they do, you know, or they're less diligent in spreading, you know, false information or outright lies. I mean, that's not the type of activism we want to engage in. We want to engage in a, you know, opinion, fact-based dialogue with the market about our ideas. But the downside is there are others that might be a little bit more manipulative and might, you know, go through greater tactics to try to create change. That's not us, but it's out there, and it's important to be mindful and hold those parties accountable as well for practicing bad activism.
So I want to help Ben out a little bit on this, because I mean, I think it's really important to differentiate between the short and distort campaigns that offend everybody, where people short sell and they go public with misleading information. So that's one category, and those are the bad actors, and that's not what we're talking about. I think the kind of short selling that Ben is describing, I actually think, and if you look at the academic literature, which is abundant in this field, is actually critical, you know, the proper functioning of markets. I mean, it really aids price discovery, because otherwise there is nobody in the market with an incentive to do the work, to discover the bad facts about a company and publicize them. You need somebody who's financially incented to do that work, to ensure that you've got price accuracy, you've got liquidity, and to help police, you know, frauds and pop market bubbles. So these are the good guys, actually.
Thank you.
You're welcome. I knew you could say that.
I'm beaming with a smile right now.
Yeah. Well, I mean, I'd love to get some examples of, from all of you, in terms of, you know, what you have found to be examples of a really effective campaign that has worked, as well as some examples that really have not. And one of my favorite, because we did have a conversation before we got up on stage, was David had one about, and I have to call you out on this one, rapier gold. If you could give us a little bit of insight about what not to do.
Yeah, and I'm going to apologize ahead of time. The rapier gold is not the most pleasant name, and on the front page of the cover, they put, "Don't let the activists snatch your company." And the word snatch was at least 5 times larger than any other word on there, and it was in bold red. They were clearly going for a a Trump-esque type of approach. The position and why they took it, I asked them afterwards and said, what were you thinking? You've now offended a large component of the shareholder base. And their argument was that it worked for Trump. They saw an opportunity to grab attention, and they thought they would do it. So the entire campaign, including the press releases and every subsequent communication, had a very strong overtone, and it was absolutely appalling. I would encourage you to go look at it and be as equally as offended as I was and many of the shareholders.
Of what not to do.
Yes.
And what about an example of a campaign that you thought was, or that you worked on that was effective?
I think Tasico was one of the better ones that we've worked on. We've got 6 or 7 that we're working on right now that have taken a very similar tone. But I think one of the key considerations as you're looking at these is be thoughtful, be measured. Think of it as a political campaign, know who you're targeting, and be engaged. If you're doing things right, you're 6 or 7 months ahead of the curve. You're using, and one of the trends that I didn't touch on was board shareholder engagement. If you're doing board shareholder engagement, you're out in front of this. There's nothing that's going to surprise you. And as I say if you're surprised, then you're doing something wrong. You should never be surprised that there's an activist at your door. You're going to hear about it, and you can actually address these issues if you're well ahead of the curve.
I just want to bounce over to Patricia, because we did talk about shareholder engagement and how a lot of companies say they do it, but do they actually do it effectively?
Yeah, I think there's the kind of routine of a shareholder engagement that everybody now does because someone's told them to do it, and they go out in the proxy season and talk to their shareholders. But I think the real engagement, the stuff that prevents the surprises that you mentioned, are that, the out-of-season meeting with your shareholders where you listen more than talk, and really get feedback on how you're performing. You don't come to make a presentation, you really come to have a conversation. And you bring your CEO and maybe a member of the board, or I think increasingly shareholders want to see the board member in that meeting, even outside of a crisis situation. The problem is that it can be hard to get your shareholders' attention outside of a crisis. And so you can't always pull that off, but that is the best guarantee against surprises.
Sunny, from your perspective, what have you noticed in terms of either companies, when you've been looking at potential targets, examples of companies that seem to get it and ones that don't?
I think, generally when you're combative or you're argumentative, it can create more issues for yourself. I think the companies that take good advisory, like the ones sitting around me, have the ability to be a little bit more thoughtful, a little bit more measured in their responses. And at the end of the day, I guess from any short sellers that look at companies that have issues and their stock price may be on the decline, the real companies are the ones that are going to put their head down and work and prove it with their cash flow and EBITDA and meeting their guidance over a longer term period of time. Like, short sellers have been wrong in the past, and they will be in the future, just like anyone who's ever bought a stock in this room. I'm sure it hasn't gone to infinity. So in that regard, usually if you're doing the right things, you will put together a company and have the right management team and make the right changes and improve your governance over time, and be a thought leader in the space that you are, and that's usually the right way of dealing with it. And then others that haven't so much are the ones that can be combative and sue short sellers or issue press releases that don't really make sense or invite further criticism.
Like what? Can you give me some examples of?
I think ones that don't. So, for instance, I think shareholder engagement can be important. So if someone's called you out for doing A, B, and C wrong, maybe you want to address it publicly, maybe you want to address it privately, but really addressing A, B, and C shows that you have nothing to hide. And improved disclosure can really help in educating the market about what reality is. And usually when you come out and you don't provide incremental disclosure, it's usually a sign that something's wrong, or it can invite further criticism.
David, you want?
I think it was Shopify that the CEO responded to the short seller by tweeting out a message that was calling him names. That's probably not what you want to do.
That's a good example.
Yeah.
Was it constructive? Yes. Ben?
Yeah, I think, look, I think where where we get frustrated sometimes is, we do a lot of work, a lot of fact-based research, and, we'll come to a company and they'll say, Spruce Point's wrong, they're a short seller, they're biased, they want the stock to go down. And of course, they conveniently omit the fact that the management team's biased by being long the stock and wants it to go up. So that's not really solving anything. I mean, look, we try to come forward with some suggestions of what a company should do. I mean, we'll take Maxar, for example. 8 months ago, I told them to cut the dividend. They didn't. They paid multiple dividends. And then finally, last week, they cut it down to a penny. And that was money that should have gone to be paying down their $3.5 billion debt load. I mean, that would have bought them more time than paying out the dividends. So, sometimes, not being listened to, obviously, is where we find a challenge. Another example is XPO Logistics, a company, one of the largest logistics and transportation companies in America. We put out some suggestions that they should change their board. We found that one of their board members had secretly been involved with a $700 million Ponzi scheme, not disclosing that on his biography. He doesn't belong on the board, and they still haven't removed him from the board. And in response to our report, they did a $1 billion share buyback. And I'm scratching my head. I went through all this grave lengths to explain how overvalued the stock is and why they should halt their acquisition strategy. Lo and behold, their business has gotten worse. They overpaid for their stock, buying $1 billion back at 60. The stock's now at 48. Listen, don't just, the second we put out a report, decide you're going to buy back $1 billion stock. Let's have a dialogue. Let's try to understand where we're right, where we're wrong. And I would ask the companies not to make knee-jerk reactions and think about what we're saying and try to have a proactive dialogue to get to the right answer. That's what we're really after.
So do you find that the initial reaction generally tends to be one where they're not seeing you as a constructive contributor here, but and maybe to David's point, is issue around ego?
Exactly. I think some of the companies we face, they've gone on immediate defensive posture, right? Without picking up the phone and calling us, or try to have a dialogue. Let's try to understand how we can, create change for the better together, rather than one versus the other. Make it adversarial. Let's make it collaborative. Let's try to get to the right answer. I mean, that's what ultimately we're trying to do.
But is it fair to say? I mean, at the end of the day, you're a short seller, so there's a certain, your interests are in the stock going down.
No, understood. But and look, we're not always going to make money. Like, we're in a risk-based business. I mean, we have a good track record of making money, but ultimately, I want to create change. That's what activism is about. It's about improving outcomes for companies and making sure that the companies, from our experience, are serving all their stakeholders correctly, whether it's employees, the analysts, shareholders, the management. I mean, that to us is what activism is about: creating change, better outcomes, for everybody involved.
Okay.
I'd just add that from the perspective of what not to do is go after the person as opposed to the information, because the voice that it comes from is generally irrelevant, and whether it's name calling in certain cases like Shopify, or it was I think Home Capital calling Mark Cahotis the chicken farmer. There's plenty of examples where people or companies have gone after the person as opposed to the information. And Home Capital is another good example of a company that did a buyback. I think they bought stock back all the way from 24 to 45. And subsequently thereafter, their stock's sub 20 now, and that's obviously not a good use of shareholder capital.
So, David and Patricia, to you, in terms of when companies become the target of either a short seller or another kind of activist, what is some of your advice in terms of preparing companies and making sure they're ready to respond in the event of? There's a lot of talk of playbooks, for example. Is that something that is really realistic? Is there a playbook to respond?
So, I mean, there's, of course, an entire industry that's grown up around shareholder activism with lots of people selling services to boards, including playbooks on how to respond. And, my view is save your money. I don't think there is a playbook that will guide your response in every situation. Every activist is different, and every situation is different. So, I mean, how do you tell a company to prepare? you know, it's easy to say and really hard to do. I think what a company really needs to do is kind of a sunny day self-assessment. So outside of the glare of an activist's, you know, light, really think about how your performance looks, and look at your total shareholder return over the 1, 3, 5 year, span that the activist will analyze performance over, and figure out, how bad it looks, and if it looks bad and it's worse than your peers, what is the explanation and what is the solution? I think it's tough for a board to do that on its own, and it's tough for an advisor to come in on a sunny day and deliver that advice, because you're not likely going to be invited back. So it's easy to say, hard to do.
Yeah. David?
I couldn't agree more with the concept of a playbook. I've been doing this for 20 years. There's never been the same proxy battle. Your shareholders are different, policies are constantly evolving, the players are different, the egos are different. So when you walk in with a playbook, I think it's doing a disservice, to be quite honest. I think it's very disingenuous too. You're not looking at this as a customized situation, and you're setting yourself up for failure as management. In terms of preparedness, I'm going to reinforce the board shareholder engagement. And that goes with short sellers. Ben's absolutely right. You should be engaging with them. You should be engaging with the analysts. You should be engaging with institutional sales. You're going to learn more. The boards don't have all the unique ideas for the company. And the more they listen, the more fulsome discussion they have, the better the result's going to be. So I think that would be number one. Secondly, would understand your vulnerabilities. And that goes through getting the advisors in place, understanding where your weaknesses are, and again, having a board discussion. I think one of the considerations that people have is, well, we're offside with the proxy advisory firms or the institutions. That doesn't necessarily mean you have to change your policies or your practice. It's something that a good discussion, individuals will listen to rational reasons why. So it's not just something where you have to change. We've seen it tens of 20s of time where there is a proper discussion, a good discourse between the groups, and they understand the rationale why it's been taken that way. The third component is understand who your shareholder composition is. Again, go back to politics. If you know who you're talking to, if you understand their policies, you can have those out of seasons. How did they vote last meeting? That's a wonderful entry point when you're looking to get somebody in August. So there's a lot of ways that you can look to engage. It starts with that, and if you can engage with shareholders, again, you won't be surprised, and it helps you get to a better place.
Well, with that, we're going to call it. And thank you so much for your time today. And thank all of you for coming and spending some time with us. And we hope that we have provided you with some food for thought. Really appreciate it. Thank you very much. Thank you.
Wow, what a fascinating discussion. My name's Anita McCouet, and I am the treasurer of the Canadian Club of Toronto. Panelists, on behalf of the club, I'd like to thank you for sharing your expertise with us this afternoon. Personally speaking, I know that many of our clients at PwC are grappling with these challenges on a routine basis, so having a plan, if not a playbook, to deal with shareholder activism is an increasingly important part of investor relations, and your insights reinforce that. And a couple of points that really stuck out for me was this idea of professional dissenters, and whether we're about to see a torrent of that dissenter activity in Canada after that ruling. The point that strong corporate governance and board shareholder engagement, while not the sexiest of topics, could be your best defense if the activists come knocking. And this idea of trying to be a little bit more polite, even though these can be really emotional situations, might help smooth things over a little easier. Andrea, you are an expert at guiding a conversation, so thank you for being our moderator today. Before we conclude, let me tell you about our next event. We've got a special evening networking event for members and guests tomorrow, March 5th. And please join, so that's the second annual Power of Networking event held at LinkedIn's head office. And we're featuring a dynamic panel of women who will address the importance of building connections. Then we take a little March break and are back with the Honorable Bill Morneau at a post-budget breakfast on Wednesday, March 20th. And I'd like to extend another round of thanks to today's event sponsors, National Capital and PwC. We would also like to thank MediaEvents.ca, Canada's online event space, and VBC for live streaming today's event. Thank you for attending, and we hope to see you next time.